At CLA, we're not just in your corner, we're on it. We're advisors and advocates, planners and patients, consultants and cart returners. We coach third on Saturdays and businesses during the week. We're your neighbors, which means wherever you're coming from, we're right there with you. Wherever you're going, we'll get you there. CLA, CPAs, consultants, and wealth advisors.
Welcome to the Iowa Economy Podcast. I'm your host, Chris Conetzkey, president of BPC and publisher of the Business Record. The Iowa Economy Podcast is supported by our sponsors, CLA and the Iowa Lottery, and is your place to get the economic insights you need to help you and your business stay ahead of Iowa's economic curve. And there's plenty going on right now that makes it hard to stay ahead. But today we're going to be following the money, if you will, right to the banks. And we're going to take a look into the health of the institutions that are not only highlight the lagging and leading indicators of the health of Iowa's economy, but also drive the ability of Iowa businesses to grow and invest in growth. With us today, we've got two fantastic guests, one local, one national, who are going to help us digest what's been happening in the banking economy, perhaps shed a little light into what might be happening in the future, all to help you stay ahead of Iowa's economic curve. With us today are Adam Gregg, he's the president and CEO of Iowa Bankers Association, and Daniel Brown, senior director of banking and financial services research for the American Bankers Association. We're going to start it off and have Adam come on. And Adam, welcome.
Thank you. Thanks for having me, Chris.
Well, I've asked Adam and Daniel, they're both going to get us up to speed with what has been happening in the economy by providing three economic insights in 3 minutes. So this is the economy in three. Adam, before you do that, why don't you tell us just briefly about yourself and your role with the Iowa Bankers Association?
Yeah, absolutely. I'm very honored to serve as the president and CEO of the Iowa Bankers Association. We are the largest state banking association in the country. We represent 97% of the banks that operate in Iowa, and we have two for-profit companies that really make us a very influential and powerful organization. We've got an insurance brokerage that helps Iowa banks, provides insurance products for Iowa banks and their customers, in addition to running a health insurance plan for 20,000 Iowa bankers and their families, and also Minnesota bankers as well. And then we also have a mortgage company. Through that mortgage company, we service over $10 billion of mortgages in Iowa and 10 other states. So it's an honor to be here. I think through this role, we can provide, I think, some helpful insight to your listeners and viewers.
Well, and that's why you're here. You touch a lot more than just the banks themselves. And banks, of course, touch every industry across the state. So, Adam, why don't you go ahead and give us your three insights here in 3 minutes?
Okay. Well, first, let's start with this. The Iowa banks are strong, stable, and resilient. When you look at other economic indicators more generally across Iowa, I think you see some mixed signals. I think every other day there's a report in the Des Moines Business Record, and sometimes those reports are growth positive or negative, and it's kind of hard to understand that. Well, with Iowa banks and all banks across the country, we have the opportunity to peer into their performance through what's called the quarterly call reports from the FDIC. And where banks are required to provide certain information, and you can kind of see how they're performing through that. The most recent call reports, the information was released in the past week or two, and I think they give us some really helpful insight. And so we can dive into some of those details there, but the bottom line is Iowa banks are protecting $107 billion of deposits, and they're using that to fund $87 billion of loans all across our state, which fuels economic growth. The second insight, speaking of the economy, would be to say that the ag economy is challenging right now, but I do think it's premature to compare it to the 1980s farm crisis. We are in an extended downturn, but the ag economy is cyclical. And I don't mean to downplay any challenges and real pain that folks are feeling. And I also want to emphasize there's a really important relationship between community banks all across Iowa and the farmers that they serve. But when you look at the indicators from the banking perspective, we are not seeing the level of challenges that rise to the 1980s farm crisis. And I hope that we'll be able to talk about some of the specifics that lead me to say that at this point. Now, things could change. That downturn extends for a longer period of time. we might be having a different conversation. But as we speak today, I think it's premature to compare it to the 80s farm crisis. And the third insight would be, I would expect to see continued bank merger and acquisition activity in 2026. Late in 25 and early in 26, we had two major Iowa banks that were acquired by out-of-state banks. This is just a continuation of a trend that has gone on for some time. My predecessor, John Sorensen, was in this role for 28 years. So 30 years ago when he started, there were 600 banking charters in the state of Iowa, and today we're at 218. The last de novos, the last new banks formed in Iowa were 20 years ago in 2005 and 2026. And there are a lot of factors that drive that. And again, I hope we're able to talk a little bit about why that may be and why we expect that trend to continue going forward.
Great job. You were worried about keeping it to the 3 minutes, but you did a perfect job doing that. So why don't we start with number one? You talked about the strong health of the banks that you're seeing. I wonder if you could zero in maybe a little bit on, despite some of those challenges that you mentioned, banks continue to have some strength. Maybe what's leading to some of that?
Yeah, well, a couple things. First of all, I always like to remind people, it sounds very basic, but we shouldn't take anything for granted. The basic business model of banks is to accept deposits and to use those to fund loans. And that's how we get all the positive impacts of Iowa banks, from doubling the money supply essentially in the community to wealth creation and all of those things. And so I always think that's a really important metric to look at. So in Iowa, through these call reports, we're able to see that we're protecting right now $107 billion in deposits. Now that actually is a slight downtick from a year ago, but that doesn't really have to do with growth of the industry. It has to do with those mergers and acquisitions, and some of the numbers that used to be counted in Iowa are now counted as part of other states. So when you back that out, it does reflect continued growth of the industry here in Iowa. And through those $107 billion in deposits, we're funding $87 billion in loans. So that's about an 80% loan to deposit ratio. That's why I say, to a certain extent, it's like doubling the money supply in the community. Banks can go higher than that, but on average, we're pretty conservative here in Iowa, and 80% is good. The other thing I would say is, again, you look at those general economic challenges, you might say, oh boy, there must be some serious loan delinquencies and things like that, and banks would start to see that. Well, that's reported in these call reports. And in quarter one, it was 0.62%. Not 62%, 0.62%. Under 1% of loans were non-current or delinquent. And so I think that gives you a decent insight. And the last thing I'll say is approximately 97% of banks in Iowa were profitable in quarter one. And so just like any other business, it's important to be profitable, to continue to grow, to be able to conserve, to serve the community. And fortunately, that was true in the first quarter of 2026.
You mentioned the loan activity, and I think you'll have to correct me if I get the number wrong, but I think it was up 7% from the previous year. And so again, despite some of that turmoil, banks are still lending at a perhaps higher rate than they were even a year ago.
Yeah, I think it's a good sign overall for the economy for there to be loan demand. And you think back to the COVID time period when there was an influx of bank deposits because the economy had been injected with a bunch of cash to get people through. But that came at a time when there wasn't a lot of loan demand. And so that presented challenges for bank management going forward and challenges for the economy overall, right? And so I think it's a positive sign when there continues to be that level of loan demand. It means businesses are wanting to grow. It means individuals are wanting to buy their first home or upgrade to their next home. And also that farmers are continuing to operate. So all those things I think are positive signs generally.
Is there anything in the strength of the numbers, anything that gave you pause looking at that you said, oh, that's maybe something I need to be watching, or maybe a challenge that banks are navigating? You mentioned the ag economy. We might get to that here too, but anything else besides that?
Honestly, pretty quiet report. That's why I think the takeaway from it is really stability and resiliency. You hear all those mixed signals, but then you look at a report like that and there isn't a lot that jumps out at you.
It's just really interesting because at the economic forecast back in January, I got kind of the same sense as we were going through the process of talking with all the folks that were participating and the reporting and reading it, and you kept hearing all this not I don't think noise is the right word, worry, concern, uncertainty that was overlaying the top of businesses. We feel it as a small business organization. We hear that. When you go look at loans and deposits and you're seeing it at the very end of the funnel there, you're seeing relative strength. So it's continued to be interesting to me that maybe that's the system reacting in real time. Everybody's navigating the challenges and figuring out how to work through them in some fashion.
Yeah, I mean, I think that's why resiliency is probably a good word. Despite that uncertainty, the economy has continued to chug along, despite really big questions that might be overhanging at any given time. So I think that's a credit to the American economy. It's a credit to the Iowa economy as well.
So you mentioned the ag economy and the challenging nature of that, and perhaps that it's a little bit premature in terms of the comparisons. So share a little bit why you think that's the case.
Yeah, well, first of all, I mean, it's absolutely true that this is Iowa, right? And to a certain extent, really almost everything in the economy does center around agriculture and how agriculture is performing, right? Not only do we have so many people engaged in the business of farming themselves, but even our major manufacturing base, so much of that is tied to the ag economy. And so when the ag economy is slow, there are cascading impacts throughout. And I think we are feeling that right now. We're in the third or fourth year of a downturn, but the ag economy is historically cyclical. When you look at, there are charts available out there of the cost of production and the value of production. And it's amazing how almost every 3 years that chart flips, and where agriculture and particularly crop production is profitable, and then it is not profitable for a while. And those are all due to major dynamics, worldwide dynamics as well. So a couple of things, some anecdotal and some hard numbers. So first of all, I've been asked a million different ways, I feel like, by the media, and I've asked my bankers a million different ways. Is this the beginning of the next 1980s farm crisis? What are you seeing out there? And from an anecdotal perspective, talking to ag bankers across the state, the renewals for operating lines went much better in 2026 than expected. Now, the expectations might have been somewhat low, but it went better than expected. And most banking relationships were able to be maintained with farmers. There are liquidity challenges for farmers. They were kind of flush with cash when things were good, and they've in 3 or 4 years of extended low prices for their commodities eats into that working capital. But that being said, so much of Iowa farmland is owned free and clear, and so there are lots of options when that's the case, including mortgaging that land and terming out some prior debt, things like that. Gives you a lot of flexibility to be able to navigate that. A couple hard numbers that I think are important to look at. So the American Bankers Association puts out a farm bank report that looks specifically at ag lending all across the country. And I'll just point to one statistic in that report. This came out in the past 2 or 3 weeks. It showed loan delinquencies overall for ag banks. So these are ag loans from ag banks. Loan delinquencies were at 0.48% nationally. 0.48%, not 48%. And in that report, they don't break it down by individual state. They break it down by region, and Iowa is considered part of the Corn Belt. So with all the headlines that you see and all the talk that you see and all the true challenges that we hear about, you might think, boy, in the Corn Belt, it must be worse. Actually, it was a little bit better in the Corn Belt, where loan delinquencies were at 0.36%. So again, under 0.5% in those raw metrics that we see coming out of the call reports. And then another set of hard numbers that I think is worth considering. I have seen a number of media reports out there talking about how Chapter 12 farm bankruptcies have more than doubled from 2024 to 2025. That is literally true, but I think it warrants additional context. In 2024, bankruptcies, Chapter 12 farm bankruptcies in Iowa were at 7 total. 7. And in 2025, they were at 18. So yes, it more than doubled, but those are historically, it more than doubled on a historically low number. And when you look at it on a broader timeline than the past 3 or 4 years, if you look at it on the past 8 to 10 years, a normal year would probably be in the 20s in terms of Chapter 12 farm bankruptcies. Now, let's look at what it was during the farm crisis. So from 1986 to 1991, there were 360 Chapter 12 farm bankruptcies. So when we're talking about doubling to 18 versus 360 over a 5-year period, I think that's why I say it's premature. Now, don't get me wrong. There is real pain out there. Iowa banks don't like to see farm bankruptcies. Believe me when I say that. But that's where I think maybe we need to just have a little bit of caution and be careful with our rhetoric around the level of challenges, and frankly, respect the serious challenges that farmers, bankers, leaders all faced in the 1980s. And let's not jump to the conclusion that because this is an extended downturn, that it is automatically, comparable to that.
Well, I know the Farm Bureau is going to be releasing some additional information here in the next couple of weeks as well, and so that'll be something that we'll be definitely paying attention to. And Adam, you'll be happy to know that I scored well on my math ACT back in high school. I like graphs and data like that. So double, anytime I see double, I say double from what? So yeah. That's just a natural part of it. A lot of times in journalism, people don't like math. I've always liked math because you can make math say what you want it to say sometimes, right?
Yeah, exactly. And again, I just want to reemphasize, I'm not trying to downplay pain, frustration, challenges that our farmers are facing. That is real. What I'm saying is the scale and scope of it is different at this point than what it was in the 1980s.
Yeah, it's a great way to point it. And I think that'd be a great graph for our team to help put in some of our products to help provide a little bit of context around as well. All right, last area that you brought up was the mergers and acquisitions and the trend that's been continuing. I'm wondering, you could talk a little bit more about that trend, and you highlighted it nicely that there's been a long-term trend here. Is that trend accelerating? Is it the slowing down? Actually, I'm not sure if you have that context right now.
I don't think it's necessarily accelerating or slowing down. I think it is just continuing at the pace that it's been for a long time. I mentioned earlier that 30 years ago, we were at over 600 charters, and now we're a little over 200. We've done some projections out. If it stays at that pace, by 2035, we'll be probably in the high 160s in terms of bank charters in Iowa. The banking industry is a little different than most industries like manufacturing, where there's a constant stream of creative destruction, right? And yes, some businesses fail, but many businesses start again, and new filings occur. So I think it's really interesting that in this particular industry, largely because of the high level of regulation that occurs, there are very few de novos that start all across the country. And in Iowa, it's been over 20 years since the last truly new bank was formed. And so that's a number that really only goes down over time in that context. But let's talk about merger and acquisition activity, because there are a number of factors that impact that. One of those is just regulations. Banking is a highly regulated industry, a highly regulated activity. And so it is difficult to break into that. And as those regulations continue, even in an environment right now in the Trump administration, where there's been a right sizing of regulations, it's still a lot. It's still a lot to be able to comply. Another factor would be, just like any other business, a bank benefits from gaining economies of scale. So it helps when a bank can get a little bit bigger to deal with HR challenges and IT challenges and the level of investments. If you can gain scale there, you can reduce your overhead. Another piece, the way that the banking industry is regulated, it's by asset size. And so there are static thresholds out there, including a threshold at the $10 billion level. And so what you often see with bank merger and acquisition activity is it's either blasting them through one of those thresholds, or it's positioning them to blast through it at their next acquisition. And so pay attention to asset sizes in those acquisitions.
So can you share a little bit more with me on that? So if you're saying that there's different stair steps essentially, and then different types of regulations, which I assume are more costly. So if I can increase the size of my bank by merging with somebody else or acquiring a bank, I might go over it, but now I have the resources to navigate it.
Yes.
Am I hearing that right?
Yeah, that's exactly right. So let's use the $10 billion asset threshold as an example. You don't want to accidentally cross that level and be a $10 billion and $1 bank and take on tons more regulation. You may have heard of the issue of interchange fees. When you cross the $10 billion threshold, you lose interchange income because the Durbin Amendment at the federal level begins to apply. And so crossing that threshold can bring additional expenses and reductions in revenues for banks. And so when they cross that, they typically want to not go from $9 billion to $10 billion and $1. They want to go from $9 billion to $13 or $14 billion and make sure that they have the scale to be able to cross that without it being actually causing them to go backwards in terms of their earnings and profitability and ability to serve their community. So that's one great example of that. And when you look at even some of the acquisitions that happened in Iowa, one of the banks that was acquired was approaching that $10 billion threshold. It was acquired by another bank that was approaching that, and together they comfortably clear that $10 billion threshold. There may have been other factors. I don't want to overstate that. But then one of the other acquisitions that happened positions the joint bank to be right at about $9 billion. So their next acquisition, if and when that happens down the road, will bring them comfortably beyond that $10 billion threshold.
Which bank? I know it was it First Mid-Bank Shares was one of them, and then Nicollet Bank Shares?
Yep, Midwest One was acquired by Nicollet. Midwest One, an Iowa bank acquired by Nicollet out of Green Bay. And Two Rivers Bank and Trust was acquired by First Mid out of Illinois. And by the way, I think those are going to go very smoothly. There's going to continue to be a major presence of those banks in the state of Iowa. Part of the reason for those acquisitions, I believe, was geographic diversity, and those banks wanted to expand into the Iowa footprint, and much easier to do that through acquisition than it is through just building out their own branches and things like that. And both of those banks, I expect, will be active members and highly involved in the Iowa Bankers Association. So, these things aren't necessarily negative; they just are.
Well, that's what my next question is going to be. I don't have a lot of experience in the area of bank mergers and acquisitions. And so when that happens, I imagine there's some positives and some potential downsides to those situations. Maybe help us understand a little bit about what those positives and downsides might look like.
Yeah. Well, a couple positives. Let's just look at it through the lens of some of the challenges that I just laid out, some of these factors, right? So let's just talk about economies of scale, right? So rather than having two HR teams and two IT teams and two compliance departments to help navigate all the challenging regulatory things that a bank has to deal with, you can gain economies of scale by combining those things, and you can have just one department that's doing that. That's a positive thing. Now, one of the possible negative consequences of that is you may not need as many people to be able to do that. There may be some roles that become duplicative. And so the hope is that there would be, a place elsewhere in the bank, or certainly somewhere else in the banking industry, for those folks to be able to land. Mm-hmm. And so I think that's maybe just one quick example of some of the positives and negatives that come from that. But, I think another example would be when banks are able to gain some of that scale, they may be able to serve their customers in a different way. By one of the regulations that a bank has to comply with is there are lending limits so that they are not exposed to any one particular borrower in a disproportionate way. Well, as a bank gains size and scale, it also increases the ability to serve those customers because their levels of capital will tend to go up as a result of that, and therefore they can extend more credit to more borrowers because they can absorb that better and differently if they're a little bit bigger.
So for a business that might be nearing that threshold with their relationship, either they would have to be looking at a different relationship or maybe multiple relationships. This might allow somebody to compete for those dollars, right?
Yeah, I think that's a very fair summary of that. And one of the things I've learned I've been at this for a year and a half. There are banks of all sizes to serve customers of all sizes in Iowa, and that is a huge asset for us, and something that I think makes our banking industry in Iowa that much stronger.
When, maybe it's easy to make a jump, and I think you'll probably correct my assumption here. When a bank from another state is acquiring a bank here in Iowa, it's not going to show up on your report necessarily anymore, the deposits and the loans. But that doesn't mean that's not happening still here in the state.
Correct.
Is that correct for me to hear that properly?
That's a reporting issue.
Right.
And so that's why, when you look at our FDIC call reports that we highlighted earlier, it looks like year over year we went down. And we did because one of the banks is now counted as a Wisconsin bank instead of an Iowa bank. And therefore, it's reported on there. So it's going to look like Wisconsin disproportionately went up. But when you look at it on the whole, we tend to follow the national trends, and the national trends were such that deposits increased marginally and loans increased marginally.
Gotcha.
I also want to mention two other factors that has to do with M&A just really quick because they're important ones. And that has to do with succession issues. We have a lot of small community banks in Iowa, maybe with only one or two branches. And it can sometimes be difficult to find somebody who is in position to be the next CEO of that bank. And so if there is not somebody who's qualified or interested in doing that, that can lead to merger and acquisition activity as a way to navigate that. And kind of relatedly, but not directly, would be we have a lot of banks that are owned by families or very small groups of investors. We have a number of banks that are organized as S corps, meaning they have less than 100 investors. Well, as you play that out over time, and maybe you get to the second or third generation of family bank ownership, they may not be as invested in keeping the bank operating. They may want to, for lack of a better term, cash out. They may not live in Iowa. They may not have a real connection anymore. When you get down to that third generation that's maybe living in California now, they may view that as a great investment that they want to continue, or they may say, I'm tired of being asset rich and cash poor. Let's sell this, and hopefully the bank can continue to operate and serve the community, but this ownership group can move on and deploy their funds elsewhere. And so you do see that occasionally. And so all of those factors, usually it's not any one that drives merger and acquisition activity. It's some combination of all of those things.
Well, Adam, I appreciate you giving us the economy in theory is a great launching point for us for our discussion today, and a number of things that I'm sure our team will be interested in continuing to look at in the future. We'll have more from our guests in a moment, but we're able to bring great conversations like this to you because of the support of our sponsors. This next segment right there with you is brought to you by CLA, a professional services firm with a rich wealth of knowledge and experience that we're tapping into in order to provide you with a hand on your shoulder and perhaps just a little bit of clarity in the midst of the economic haze. And right there with me today is Tyler Lind. He's a principal at CLA Des Moines. Welcome, Tyler.
Thank you. Thanks for having me.
Well, Tyler, why don't you tell us just briefly about yourself and your role there, but then also, there's been many organizations that rely on R&D incentives. The recent tax changes have added some complexity to that world, which is already a complex world. What's changed in how the R&D costs are treated for tax purposes?
Yeah, so like you said, I'm a tax principal in our Des Moines, Iowa office, and I primarily work with privately held businesses throughout the state of Iowa. And, a good subset of those are, doing various R&D related activities and therefore qualify for the R&D credit. And it's a really big incentive for companies to continue to innovate and create new products and new processes and become more efficient. And so there have been a lot of changes over the past few years that you mentioned, and dating back I'd say 2022, businesses have been able to fully deduct their R&D expenditures. And starting in 2022, they were no longer able to do that. They had to capitalize them and essentially amortize them over a period of time, which essentially resulted in a deferral of expenses that they could take on their tax return. And because of that, it just created, again, paying additional tax up front and, kind of having to wait for the benefit of the cash that went out to fund these projects. And so starting in 2022, they had to capitalize. Then, Congress kind of reversed course as we got into 2025 and, allowed not only full deductibility moving forward, but also gave the ability to deduct those costs that were previously capitalized for that 3-year period of time. And so businesses are faced with, okay, now, we know how to treat it moving forward, but how do we handle those costs, that were previously capitalized? And it really provided an opportunity for companies to determine, am I eligible to go back and amend returns? And maybe there's a better benefit there. Or do we just, take those costs moving forward? And so again, it created this modeling opportunity to, give them flexibility on how they treated those costs, that were previously capitalized.
I imagine there's a lot of opportunity within that to find the best pathway forward. It's not always black and white when it comes to these things. What are maybe some of the considerations businesses should be thinking about there?
Yeah. So really, when I'm thinking about the pure numbers standpoint, looking at, do we have the ability to amend? Some companies did have the ability, some did not. So that's maybe the first step. But then, where's the income? Were you in a higher tax bracket? Maybe were the owners in a higher tax bracket in a prior year versus what's expected in, future years, or maybe it's vice versa. And so again, there can be a tax rate play there of being able to take costs and take expenses at a higher tax rate, depending on which option you choose. And so again, it did provide an opportunity where maybe a little bit of planning allowed you to, get a bigger refund through that process.
I understand Iowa has some changes as well to its R&D tax credit. They're starting in 2026. Maybe help us understand what's happening at the state level and maybe what those effects might look like.
Yeah, and completely independent of the federal changes that I just spoke about. The Iowa side, they are moving more towards an application basis, and so no longer are you just claiming the credit on your return. You are now essentially going to need a independent CPA verified report that you ultimately submit with an application for the R&D credit. The total credits are capped. The total, credit rate is, a little bit lower than what it has been historically. So the benefit is not going to be quite there. And there are some hoops that we are going to have to jump through. And so it really is, not only is it going to be a requirement that you work with a CPA, but just more and more it is becoming more impactful to work with a CPA to make sure that not only are you, getting the proper documentation for the credit in case of an exam, but also you have everything set up, and so you're ready to kind of hit the ground running and take all the different opportunities that are available for you.
It's a lot of change for organizations that have been in this space or are considering it. If an organization's feeling a little overwhelmed, what's maybe a first practical step that they could take to navigate through this?
Yeah, it is. It's a very complex tax credit, both on the federal and state side. And so really working with somebody you trust, whether that's CPA, attorney, working with somebody that can help make sure that are we following the proper protocol? Are all of our projects that we're working on truly qualify for the R&D credit? Having the substantiation ready to go, it's much easier to have that in real time as opposed to trying to go back and try to create the documentation to support what you have. And then ultimately just, making sure that, the person that you're working with is qualified in this area. It is very complex, but there's real opportunities to ultimately qualify for a higher credit if you know exactly what does qualify and what does not, and you can kind of tailor your approach from there.
Well, the exam that you mentioned sounds like an exam I wouldn't want to take, but if I had to, having CLA with us for that exam would be one that would certainly be helpful. So thank you so much, Tyler, for your helping us understand a little bit about the tax credit today. And thanks for joining us for Right There With You. I'm glad CLA is going to be right there with us all year long. And if you want to learn more about R&D tax credits, you can contact Tyler at his email and find additional CLA resources at claconnect.com. All right, we got the local view from Adam. Now we're going to zoom out just a bit and bring in Daniel Brown. He's the Senior Director of Banking and Financial Services Research at the American Bankers Association. Welcome, Daniel.
Hey, good to see you today. Thank you for having me.
Great. Well, we've asked Daniel to give us the economy in 3. We've asked Daniel to give us the economy in 3. So Daniel, you've got 3 minutes. Go ahead and give us 3 things we should be looking at.
Sounds good. Really want to kind of focus this on the banking sector. And I know that, there's been 2 fairly significant mergers in Iowa from banks outside of the state. And actually, since 2024, there have been 383 announced M&A deals here in the United States, and 301 of those have closed. And there are several reasons for this increase in bank mergers, including the fact that inflation is really increasing the economies of scale thresholds and effectively pushing up those fixed costs for banks. And the other part on that too is that a lot of these federal regulations in the banking sector, they kick in at fixed dollar thresholds. So whether that be 1 billion, 10 billion, 100 billion. And when you sort of combine inflation and economic growth, it creates a situation where more and more of banks in the United States have to comply with these regulations. And what you end up seeing is outsized activity of M&A deals sort of occurring just below these thresholds. Because what happens is with these banks, they're just below these numbers. You kind of have one of 2 choices, is that either these banks can discourage organic growth and they kind of grow slower than they would otherwise, or 2 is that there's really an increased pressure to merge in those situations. The other thing that's happening in terms of M&A deals is that this is the time regulators are approving and pushing through these mergers. And so the number of days that it takes to complete a deal has decreased from 220 days in 2024 to 170 today. And so now is the time, and that window might not necessarily always be open. And then in terms of demographics, we have a lot of sort of, older CEOs, and succession planning is definitely a difficult endeavor for our member banks. And so as, we sort of have an outsized, generation leaving the workforce, going ahead and doing an M&A deal during this situation might be a way to sort of maintain a similar culture and also make sure that these banks are sort of, continuing into the next generation, so to speak. And then sort of in a more ideal situation, when you have increased M&A activity, you would have a situation where you'd have upstart de novo banks sort of coming in addition to M&A to sort of keep the number of banks in the United States relatively stable. But the problem is that you don't have upstarts forming sort of on the regulated side, but you end up having these sort of non-bank financial institutions come in where they kind of get the best of both worlds. They make loans. Some of them are trying to get Federal Reserve skinny master accounts or payment accounts, but they don't have to be regulated or supervised like a more conventional bank. And, that sounds great, but that's, only until the music stops, and that regulators have almost no visibility into these institutions. They hold significantly less capital than banks do. So if something were to occur in the financial system, they wouldn't, hypothetically have the resources or the capabilities to sort of weather that economic volatility. And, it really is a risk of moving a lot of financial activity outside of the banking system that a lot of times we don't really see it until it's too late. There could be shocks, whether it's buy now, pay later, or, there was a lot of talk earlier this year about private credit's exposure to software. Those could potentially be scenarios, but it also could be something that you and I don't see until it's too late. Because there's a lack of transparency with these non-banks. And the third thing that to take a note out is really sort of making sure that there's a robust and very stable and resilient deposit base when it comes to the banking system. When we have bankers come into DC and talk to us and sort of ask them, what keeps them up at night, deposit retention is definitely a key one there. So, when we talk to bankers, they know that back in the day when you got sort of your year-end bonus, you deposited at the local bank. That bank went ahead and lent some of the money to the local small business. Then the depositor, gets some interest, and things worked out great. But today, that depositor has a million different options about where to deposit that money, whether it's a bank, a fintech, a gamified brokerage account, or I guess too, you can go ahead and put that money into a sports gambling account or even a predictions market. And so we've gamified a lot of these apps with these splashy interfaces, which sounds great, but I do believe that there's a lot of risk in that. And now there's even the debate about whether these crypto or stablecoin companies can pay interest, which also is a significant risk for bank deposits. And that also could have a downstream impact on economic dynamism. Is that more deposit competition means that there's higher loan pricing then for businesses and consumer lending. If either that consumer wants to go ahead and buy a home, or that business wants to start a business, expand it, et cetera. And it might be hard to see on a micro level, but I hope the story that I provided to you today sort of sheds light on the challenge that banks are dealing with, and really sort of emphasizes the importance of making sure that there's a strong deposit base here in the U.S. banking system.
Appreciate you giving us the 3 and 3 there. That gave us a really good look at what's going on here from a national perspective. And a lot of those trends are things that Adam, of course, touched on that are affecting banks here in Iowa as well. I wonder if maybe you have any information that would help us understand where Iowa kind of fits in on some of these trends. He talked a little bit about the effects here, and I wonder how maybe Iowa might compare or differ to some other states that you work with.
I think it's doing pretty well. I know that, there is Iowa definitely has much more of an agricultural focus, and that there are definitely some headwinds in regards to the agriculture industry. But I do want to kind of highlight 2 fronts. Is that one is that farmland prices have been appreciating quite nicely. In fact, I know that, home prices have gone up a lot, but farmland prices have gone up even more than that. So in that situation, that sort of provides a cushion for a lot of farmers in the state of Iowa and broader. And then the other thing on that front as well is that a lot of the livestock profitability and things of that nature has stayed, quite nice and quite stable. So I think that's another segment of the ag industry that's doing quite well. I know that, the ABA just released their farm bank report, and the bankruptcy numbers in there were actually significantly lower than years past. So we're kind of looking at it from a situation is that in the ag industry, and I know that's a huge part for Iowa, is that there's definitely some things to monitor. But at the same time, too, though, is that it is sort of in a relatively good spot at this point in time.
I know just a few years ago, there was a lot of concern. There was some challenges at a national level with some banks and some bank failures. I wonder if you could just share a little bit. It seems like that hasn't been in the news of late, and just curious the general health of the banking industry and what you've been seeing. And that was one of the topics we talked about was, despite the challenges from an ag standpoint, the number of actual Chapter 12 bankruptcies is relatively low here in Iowa. And just curious what you're seeing maybe at a national level.
Yes, absolutely. The latest quarterly bank performance numbers actually were released last week, and it looks like that the numbers show that banks are in a good place right now. Is that net income for banks was $80.5 billion in the first quarter, which was an increase of $2.8 billion or 3.6% from the prior quarter. We have some pretty strong loan growth, up 1.6% in the first quarter. Another thing I want to flag too is that in light of the 2023 volatility, there was a lot of concern about commercial real estate, this idea that was going to be the next shoe to drop, that the entire professional class was going to be working remotely, and that there was a little bit of volatility there. But we actually were looking at the delinquency numbers on CRE, and a great example of that is that for the largest banks that were more predominantly involved in office lending, their non-current rates are down 32% basically from the peak in 2024. So we see a sort of precipitous decline in terms of the non-current and delinquency rates for CRE for the largest banks, and for smaller banks too. I think the performance on CRE has stayed quite stable, and so we really do kind of want to just highlight that a lot of those concerns that were sort of being risen to the top of the pile, so to speak, a couple of years ago have really sort of diminished, and shows that the banking industry is in a quite sound and stable place at this point.
Last question, maybe before we move on to the next topic, but you talked about the upstart banks, and I'm just curious, in a place like Iowa, I think we haven't had many for a decade plus, I think. What does it, is that something you all are working on as an institution, going, how do we help in that area? Is that something that, I know there's a lot of barriers to starting a bank, but I'm curious if I could just learn a little bit about what it takes if you're trying to start a bank, I guess.
My understanding is it takes a lot, and there's been a lot of delays in regards to getting things sort of approved and things of that nature. And I do know that Vice Chair Bowman at the Fed is really sort of hammered in on this particular point. She was a community banker herself in the Midwest. And so, really sort of trying to find a way that we can create that next generation of banks is going to take a full-fledged effort, not only from, the private sector, but also our partners at the bank regulators. So that's something that it continues to be an uphill battle, and finding and identifying ways to do that has been a challenge, but it does seem like that we're starting to get some people, over in positions of power that understand some of the need for that, and working towards getting to a place where we can have sort of a healthy churn in the banking industry, where yes, there is M&A deals, but at the same time too, that we also have a healthy pipeline of the banks of the future to go ahead and meet the financing needs of consumers and businesses across the country.
Great. Thanks, Daniel. Thanks for giving us a good firm foundation for us to help us understand what's been going on in the banking industry over the last few years and what the trends look like going forward.
Thank you.
Every game from the Iowa Lottery gives you the chance to become a win-ionaire. Living rich your way. From a looks like lunch is on him-ionaire, a world's coolest aunt-ionaire,
Don't tell your parents.
and it's finally all ours-ionaire. Or a permanent vacation-ionaire. No matter what, where, or how you play, you can be a win-ionaire with the Iowa Lottery today.
It's time to turn our eyes a bit to the future, and I've asked Adam to share one economic issue or indicator he thinks business leaders should be watching in the future. So, Adam, why don't you share with us? You gave us a good heads up of where we are. Talk a little bit about what things we should be watching for.
Yeah. Well, what I have in mind here, to a certain extent, is a political issue, but it has economic impacts to it. And the issue is this: what is Congress going to do with the issue of stable coins? And specifically the issue of whether or not stablecoin issuers can pay interest, yield, and rewards on stablecoin. So this is kind of in the weeds, but I think it's important to understand because it has deep impacts on the industry. So Congress passed and the president signed last summer the Genius Act, which created a regulatory regime for stablecoins. So stablecoins are a type of cryptocurrency that are pegged to a stable indicator, usually the US dollar. And if you could describe in a nutshell the point of those regulations, one major point was to say that this is meant to be a payment mechanism and not a store of value. But what has ended up happening as the way things have played out is that there's kind of a loophole in that. And while Congress banned issuers from paying interest, yield, and rewards on stablecoins, what's actually happening is the issuers are paying those rewards to third-party affiliates or to the exchanges on which the coins are traded, and those are being paid to the holders of those. That's a problem for a couple reasons. Number one, this was meant to be a payment mechanism, not a store of value, not something that could encourage deposit flight from banks and other traditional financial institutions. So what's happening right now as we speak is Congress is considering a second bill around cryptocurrency regulation. They call it the Clarity Act, or sometimes it's referred to as the Market Structure Bill. One of the fighting issues in that bill is the issue of trying to fix this loophole, which is being exploited by stablecoin issuers. And circling back to the conversation that we had earlier, this goes back to the fundamental role that banks play in Iowa and the United States. We take deposits and we use those to make loans. And so in this case, stable coins are not as highly regulated as banks. They do not have protections like deposit insurance. They are still sorting through what the rules are going to be on capital requirements and leverage ratios and all of those things. But they're not likely to be equivalent to banks. And so it's important that consumers understand that, in that stablecoin be used for, I think, what it was really intended for, which is as another payment mechanism in the same way that a credit card can be, in the same way that a debit card can be, same way that a wire, ACH transaction, a check, any of those things, just one of those, but not something that is a risk for deposit flight.
When you're thinking about some of those things, it's a variety of new technologies and things like that. And so rules happen and there's downstream effects of those. Are you hopeful that there's going to be some change in that area?
Yeah, I mean, and that's, I think one thing I want to emphasize is that banks aren't afraid of innovation. We would want to be a part of this, right? But if banks are going to issue stable coins and offer that or something like it to their customers, we also got to be playing on a level playing field with everybody else who is in that same business. And we've seen too many examples where that has not been the case, and it gives a competitive advantage that I think isn't justified to some of those other platforms or some of those other industries. And this is just another example of that. And so welcome innovation. We want to be a part of that. In fact, in Iowa, we have a company called Shazam, which is an important partner for banks, not only in Iowa, but throughout the Midwest and throughout the country. There are a number of us, including myself, some of my banking leaders, and even some of the credit union leaders who have been part of a working group with Shazam that has examined how could Shazam help Iowa banks navigate this space. So it is definitely not a scenario where we have our heads buried in the sand. We're just Luddites who don't want to engage in the newest technology. We just want to make sure that the rules are fair, that the rules are clearly understood, and that everybody's playing by them.
Well, I'd imagine that's, as we've talked about the mergers and acquisitions component of things, your role as the Iowa Bankers Association and providing additional support for banks when there's all these different types of challenges happening makes your role even more important.
Absolutely. And I think there is a role to play for the association to have those conversations, to consider, does it make sense to work collectively to issue a stablecoin in Iowa? Or are there other products that provide some of the same benefits in terms of being on the blockchain and providing instant payment capability, like a tokenized deposit product that might make more sense for banks to offer their customers? And so it'll be interesting to see where it all goes. But I mentioned it as a future issue, and it's a political issue, but it's also an economic issue. If Congress allows for this new product to exist out there that is really attractive and maybe is confusing to consumers about what protections it does or doesn't have, it provides a level of reward or yield that outpaces what's available from your traditional institution, and it causes deposit flight in a way that jeopardizes lending, in a way that maybe jeopardizes that consumer's funds in a way that they aren't fully appreciating. I think that's really concerning, and it would have downstream impacts. Again, we go back to the fact that Iowa banks are protecting $107 billion in deposits, and they're providing $87 billion alone. Well, you take billions of dollars away from that first number, and it's going to impact what's available for that second number. And that has impacts on our economy. It has impacts on wealth creation. It has impacts on the money supply, has impacts on economic growth in the state of Iowa when that small business is coming and seeking a loan to grow, when that farmer facing a fourth or fifth year of a challenging ag environment needs to borrow a little bit more. Well, there's got to be deposits to be able to fund that. When that young family wants to purchase their first home, again, that's funded by deposits. And so it sounds like such a basic issue, but it's a really important one for our entire economy. And listen, this has worked for literally hundreds of years. Banks have been the engine of wealth creation. Let's not break that. Just keep it going. Let's not chase something just because it's shiny and new. Let's make sure that we're doing these things responsibly. And banks have been a partner in that for hundreds of years, and we will be for hundreds more.
Well, you've got a little past experience with legislation and working through politics. So we'll see. Maybe you and the Bankers Association, I know you guys are heading out to DC in a little bit as well. So maybe you can get to work on that solution for them.
Yeah. We look forward to having conversations with our federal delegation. We have great participation from our Iowa bankers. It's part of the reason why we're such a strong association. So we'll have about 35 Iowa bankers joining us in Washington, D.C. to have these conversations and talk about the stakes with our elected officials. And they're always so gracious to give us the time and to hear us out and, tend to agree with us on a lot of things. And so we always appreciate the conversation, and that we live in a country where we can do that, and we can do that confidently and impactfully.
All right, Adam, last question for you. Is there maybe a data point or that people maybe aren't paying enough attention to, or something that you would direct business leaders to look at so that when they're hearing different headlines and things that maybe people should be looking at in the future if they want to kind of know how banks are doing?
Yeah. Well, let me twist that just slightly. And it's less about bank performance, but I think it does have impacts on the economy. So back to the conversation around the ag economy and what distinguishes this from the 1980s farm crisis. One of the big distinguishing factors is the value of land. Part of what happened in the 1980s farm crisis, that land values tanked. And so that impacted a farmer's equity. It impacted the level of flexibility that banks were able to provide to those farmers in that situation. And it presented serious challenges. So one of the things that has distinguished the current downturn from that is, frankly, ag land has stayed high in value. And maybe it's the increase in that value has slowed, but it's stayed essentially pretty steady going forward. That's one metric that I would watch going as we go forward, because I think that could have an impact if you started to see a real precipitous decline in ag land prices. That could present deeper challenges for farmers, for banks, for really the entire industry. Now, all that said, I don't anticipate that happening. Everything that I see and hear suggests that a lot of this is driven by supply and demand. And there is just more demand for Iowa farmland when you look at it over a decades long term than there is supply of it available. And that tends to keep prices high. And in some cases, it's almost mind-bogglingly high, but that has been the dynamic. And so that's one metric I would watch where, if that changed, that could change, I think, how everyone's feeling. But again, I would also remind you, something like 80% of Iowa farmland is owned free and clear of a mortgage. And so if you're not borrowing against it, if you're not selling, if you don't need to immediately sell it, that may just fundamentally be different than what it was like in the 1980s, where it was more leveraged. There was less land owned free and clear. But that's one metric I might suggest could be an indicator for the entire Iowa economy.
Well, thanks for sharing that, Adam. Anything else you'd like to share before I let you go?
No, I appreciate you having me on. The Business Record's been a great partner for the Iowa business community, and we appreciate the opportunity as Iowa banks to be able to talk about the important role that we play in our economy.
All right. Thank you, Adam.
Thank you. 3,
2, 1. All right. We're going to bring Daniel back now to turn our attention to the future. So Daniel, welcome back.
Thank you.
Daniel, we've asked you to give one indicator or an economic issue you think business leaders should be watching in the future. So go ahead and give us something to look forward to.
Sounds good. And I think it's the big one. It's the debt and deficit, where the national debt now exceeds $39 trillion and the annual budget deficit's about $1.8 trillion. And in May, the U.S.'s national debt surpassed the country's GDP, which it did that for a little bit during COVID, but this is really kind of the highest it's been since World War II. And I'm not going to sit here and tell you that the U.S. needs to manage its debt like a household, but these are unsustainable levels that have negative impacts for businesses and consumers. There's some really interesting scenarios that the Congressional Budget Office forecasts that really do look, quite scary. And so it does kind of highlight that something needs to be done about it. But I want to kind of quickly, tie that into the banking sector, though, is that, maybe a lot of people don't realize this, but, when it comes to the pricing of financing, is that a lot of this is going to key off of the U.S. debt and the notes and bills that the Treasury issues. And so when investors have concerns about the U.S.'s ability to repay this high amount of debt, it increases the interest rate on the mortgage for the home that you want to purchase, or it also increases the interest rate on the small business loan that the local restaurant's trying to acquire. So, if the federal government, reins in its spending, it's a huge positive impact on businesses and consumers trying to achieve the American dream. So that's something that, we're continuing to look at. It's a big challenge, but at the same time, too, there's also huge upsides there if that were to be addressed.
Well, I won't ask you how you're going to solve the debt issue, but I am curious. In some of you said the congressional budget had some scary scenarios. What does that look like? Scare us a little bit, that maybe pull us back from that. So.
No, definitely. Part of that has to do with kind of the demographics we have in the United States, is that when you sort of have an older and older population, is that you end up having a higher share of the U.S. Population, either on Social Security or Medicare. And so, basically they're going ahead and showing that these debt to GDP numbers could end up, getting to, in the future years and decades, above 200%, maybe even above that. And, there is precedent to this from a sort of an international perspective. I know Japan's numbers are quite high. I think it's over 200% debt to GDP over there. And, they're still functioning as an economy, which does look great. But at the same time, too, though, that also means that, financing becomes more of a challenge. So that's something to look at. There are parallels in other parts of the world, but at the same time, too, though, is that there's also drawbacks to reaching those levels. And it ties right back to banking when it's all said and done there.
When you think about things that maybe you'd be watching, an indicator, something that if people want to be we've seen a relatively stable standpoint from a banking standpoint. But I think one of the incongruences that has come up is that there's a whole bunch of things happening on a national, international level, a lot of concern and worry about trades and tariffs and all these type of things. And yet banks seem to be continuing to do pretty well. Is there something you'd be watching to go, hey, there is actually a turn happening and it's not going in a good way, or something that might be saying, hey, this is an indicator that there might be a lot of positive opportunities coming forward?
I'm watching the 10-year treasury, and that's what a lot of financing is keyed off of. It's what your mortgage rate's gonna key on. And I think also it's sort of a barometer of how investors are looking at the ability of the U.S. to repay the debt and deficit in a lot of ways. So that's kind of what I look at. The other thing that I think people sometimes forget is that the liquidity there is much deeper than the stock market or equity markets. So with that's sort of a good barometer. And because there's all that depth there, is that it doesn't lend itself to volatility in the here and now. And so that's sort of the thing I look at every morning to kind of see where we're at, because we are in a situation these days where it seems like markets move on a daily basis in wild ways, either one way or another, and that's kind of the way that you are able to see whether or not things are sort of turning in one direction or another, or if it's just sort of the daily volatility that just goes in with market movements.
And then point us to something maybe positive that you think is, as we're going forward, something that might make you a little bit bullish about banking and the economy.
Definitely. It does seem like that the business community is in a situation where they were able to, because the thing I'll say is that the business community has dealt with a lot of headwinds over the last, say, 6-7 years. They dealt with the pandemic, they dealt with inflation, and then there was the tariff situation too last year. But what we end up seeing in terms of commercial and industrial loan demand, and then in terms of business sentiment, things actually look very good. In that we basically have created a business community in the United States that has been extremely battle tested through all of these waves of volatility. And so because of that, they really are in a situation where they can kind of handle, whatever may come into the future. And that ends up having downstream impacts on a positive level in terms of the banking sectors that, banks end up having clients there that have, strong credit quality, strong balance sheets. So if they're going ahead and looking for that next acquisition, if a business is looking to go ahead and expand, things of that nature, these businesses are quite battle tested and will have, sort of a strong case to be made in regards to trying to go ahead and acquiring that next loan to make the next step in their business development.
It's been interesting. A lot of when we had some conversations like this, we talk to business owners and you say, well, how do you feel about the Iowa economy, or how do you feel about the national economy or a global economy? The further you get away from their actual business, the less confident they feel. But when you ask somebody about their actual business performance, they tend to feel very bullish about it, despite the things that are happening. It's like, in spite of X, Y, Z, I still plan to be growing. I still plan to be investing. That's kind of been a common theme. It's not across every industry, of course. But it just feels incongruent, because when you're asked about how's the economy doing, we got all these things that are happening that are potentially affecting us. But then people continue investing, and that's showing up in the numbers that you're describing when it comes to loans and deposits. So.
And I think when you aggregate all those small businesses together, so then you have thousands or millions of business owners that feel very confident about their business line. They've specialized it. They've dedicated their livelihood to it. And like I said, because they've been through what they've been through over the last couple of years, they're in a situation where they're definitely able to sort of handle whatever may come at them in the future.
Well, Daniel, I appreciate you giving us a little bit to look to the future. Anything else that you want to add before we let you go?
I think we're in a good shape at this point. If you look at the aggregate numbers in terms of, where we are in the economy, it looks like that the GDP forecast for Q2 look good. In terms of the unemployment rate, we're at 4.3%, which is a very strong number. So on an aggregate basis, things look good. And I know that there's always challenges ahead. There's always cracks underneath the surface. I know that there's a lot of concern in regards to, what may come with the future of work and artificial intelligence and things of that nature, and what sort of the future economy may hold. But you sort of look at that from the small lens, you zoom out a little bit, and you look at the gross numbers, things look actually quite nice at this point in time. So I think that will end up boding well for the banking sector and the economy at large.
Well, thanks, Daniel. Appreciate it. And thanks for giving us a nice national perspective on what's been going on with the banking industry. And of course, a big thank you to our guests, to both of our guests for helping make a little sense of the economy and providing us with a peek around the curve and what we should be watching in the months ahead in the banking industry. And of course, to our sponsors, CLA and the Iowa Lottery. We can't put on programming like this without the support of our sponsors. So I hope you take a little bit more time to learn about CLA and the Iowa Lottery. And of course, if you enjoyed today's show, please like and subscribe and tell your colleagues. I firmly believe we're stronger as a community when people have better information to make better decisions. That's what makes your business better and our community stronger. Thank you for watching. And until next time, keep your eyes up and peering ahead of Iowa's economic curve.